Now, before we get into it, I'd like to remind you, please like, share, subscribe. Your support is always appreciated. Now we're going to turn to what is happening in the U.S. market, the U.S. products market, and what does that mean for demand as we start coming into a seasonally strong period. So when we take the aggregate that we always like to look at of finished motor gasoline, jet fuel, disti, and resid, you get an idea of where we sit versus those historics. So we did get a nice little bump this week. The current was 14.673 million barrels a day versus last week's of 14.2. Bringing our average to about 14.5 or so, 14.45. So when we look at where this is going to go, we continue to see kind of this flatlining. I still think that we start to see a little bit of a rollover, but clearly, the distillate side remains very strong. So we likely will not see a movement back below 14 million. Instead, we're going to be closer to that 14.2 or so, just as things normalize as we head into the summer months. Now, when we think about what do refiners normally do, what normally happens at the rack, which is where those the tankers fill up before they go to the gas station, you always front run. So there's always that movement to make sure that you have enough gasoline in your tanks, that you have enough capacity. So we'll start to see some of these movements coming out of storage, and that will really start to increase in terms of some of that movements that we continue to see on the gasoline side. Again, within reason, given this is when it's supposed to happen. So we typically see kind of a spike, and then we see things settle out as there's a preparation for Memorial Day and the first 2 weeks or so of driving season, which we'll talk about. So first, we're going to look at what's happening in the distillate market, which had a drawdown of 3.34 million barrels. And you can see that really brings us in line with the 5-year average. So now we're essentially just flat against the 5-year. And this is just coming into kind of where things sit in general, because when we think about the imports, as we've been saying, imports were going to continue to come down. They're right back in the 5-year average, so there's not too much to see as an adjustment. And when we look at the 29-year capacity, we typically see these drawdowns and then things flatline and normalize. Now, we should continue to see a bit of a drawdown as the focus remains on creating as much gasoline as possible. And with that being said, when we think about yield in general, so the yield on gasoline at the refinery level came down a little bit, but it's still at 63.7%, which is 5% above the 5-year average when we think about those movements. Now, that's down 2% week over week, but you can only create so much gasoline depending on the time frames, what you're trying to create. Where when we look at production of distillate, it remains at near lows or the 5-year lows when we look at just what the production accounts for. So the focus still remains gasoline. But when you make diesel, you inherently make gasoline. So the question is always going to be, what is the quality of the gasoline you created based on the API gravity, and what process did you use? Because there's multiple different ways to create the same product depending on the slate of oil and what quality you want on the back end and other products that you might want to create along the way. So again, this is something that is going to continue to move down. We'll see demand dip just because that heating oil movement, and that will slow, or the rate of change of these drawdowns will stop, will lessen, but the draws will continue as diesel remains robust in the market, just given trucking and rail capacity. So when we think about demand, as we've been saying, we remain above the 5-year average. Don't see that changing in general. You can kind of see that on a 5-year average. We normally see this spike up when we think about where things go, and then we get a little bit of a slowdown as things stabilize. But just because of that diesel demand, we're going to remain above that 5-year average. So we will see distillate still remaining as that kind of core component for some of that bullishness that's going to stay in the market. And that's really just going to continue to be driven by what is that demand for trucking. When the Econ show, we'll talk about inventories and shortfalls, delivery times. All of these things still remain a key issue that remains a residual in the market. It's not going away anytime soon. So every time you hear the term transitory, just ask, well, define transitory. Like the Texas freeze off, that was transitory. That was a 10 to 14 day event. So, okay, 10 to 14 days, to me, that is transitory. Is it 6 months, 10 months, 24 months? But again, this is where we continue to see some of that pressure. And when you look at load availability, there still remains more than enough cargoes out there. So truckers are in high demand. You're seeing a lot of capacity coming through. They're trying to hire. You're seeing six-figure salaries to be a trucker just because they're trying to get guys back into the market. But when you look at rates in general, rates continue to be strong. Don't see that changing. Diesel pricing has flatlined at the moment, and just given where some of the shifts are, we'll still see a steady increase, but it won't be at the same pace as gasoline, just because gasoline is going to get that conversion into summer grade, which again is going to push us closer to the $3 mark, where this diesel will start moving closer to that $3.20, but it's just going to take a little bit longer to get to that point. Now, when we look at rail traffic, it gets interesting because this is where we have peak COVID problems. But when you just look at where this sits in general, there's still a significant amount of demand that remains this week in the market. You're seeing that demand for grains. In the Econ show this week, we're going to talk about where those exports are going, how they remain robust. China's already started buying next year's corn crop, just to give you an idea of where we sit, which is why ethanol is going to become very expensive. More expensive than it is now, just given where corn prices are. But, the motor vehicle side, there was essentially an all stop last year, just because nobody was buying cars. You couldn't even get into a showroom. So to see those increases, we're just getting kind of back to some sort of normalcy in general. Where intermodal, now given these numbers are elevated, we're still going to see intermodal movements increase because we still have just massive delays across the board. Even through the slow period of March into April, we have barely been able to make a dent in some of these shortfalls, especially on pad 5, which is going to be that residual that's going to continue to be a problem, which will require more trucking, will require more rail cars to just move this stuff into the system and get it to where it needs to be throughout the supply chain. And this is where we continue to see this creep up. When we look at April 25th to May 1st, and then when we look at May 9th to May 15th, we keep getting them. You see the increases versus the previous week. Now, previous years are obviously going to be tough, but week on week, the numbers continue to go up. And the hope was that we were going to see some of this normalize a bit, and we're just not getting there, which again is going to leave some of that residual in the system and keep that bid in that diesel demand side of the equation. And when we look at what's to come, as we look into May, the first 2 weeks of May, we get a pretty decent warm up. It won't be enough to see this big increase in electricity consumption. There will be an increase in electricity consumption, not saying it won't be, but that again, that's just going to be that heating oil is now done. You're not going to have it kicking on in the middle of the night. And again, that's just kind of that residual because we had that nice little last push, which provided that backdrop, which is going to, now slow down as we go firmly into kind of that shoulder demand season when we're thinking about heating oil into then air conditioning. So now that when we pivot over into gasoline, you can see that gasoline had a small build of about 90,000 barrels. It was driven by Pad 3, which saw a big increase in imports when we look at the 5-year average. And as we said last week, we were going to see imports come down. They were still going to be elevated versus historics. So they were down 98,000 barrels a day. But year over year, that's up 792,000 barrels, and more importantly, against the 5-year, up 319,000. So we still have that residual. We still have more coming through. And then just putting that into perspective. So gasoline arrivals slumped to 402,000 barrels a day, which is the lowest since the week ended March 18th. Shipments eased from that revised, which we had that 610,000 observed the previous week, which was the highest since July 2019. So they're still coming, they're still there. It's just they've been staggered a bit more to avoid some of the congestion. So we will see some of these imports, roll over a bit, but it's same thing where they'll be down week over week, but still elevated against the 5-year average. Now, when we look at gasoline stocks against the 5-year average, tough to use against year over year because of obviously COVID, but against the 5-year average, gasoline is below it by 6.3 million barrels. Which again is also skewed because of the 2020. So if you take that out, we're getting closer to the 5-year average because we flatlined. And when you look at the 29-year level, you can see that this is when we typically get some drawdowns, and we've essentially flatlined, which is what we normally do. It's that rate of change from March into April really kind of stopped, and then we went flat. And we're going to continue to see that as imports remain robust. And well, three things really. Imports remain robust, gasoline creation or yield remains elevated, and exports remain fairly muted. So again, those things will keep import storage fairly flat because we do have stronger demand, as we will continue to have stronger demand through into the Memorial Day weekend. So again, these are going to be those kind of pivots that we're going to continue to look at. Now, this is just taking Gas Buddy data, and if you look at the last 4 weeks, you've seen that steady, move lower. But as we said when we had that peak, as we headed into the back end of Easter and spring break, we expected to see a normalization. But as we said, it wasn't going to be a huge drop. It was just going to be, okay, we're going to be down 1.5% as we get into this plateau level as this comfort. And then we'll start to see as weather gets better, you'll start to see a little bit of a creep back up. And then as we get into Memorial Day weekend, we should be either right back to or right above that Easter break. So again, that's going to be, we'll see a little bit of a flat line. And then we'll start to see that pick up as we go through, because Gas Buddy's looking at what are people doing at the pump. And you're going to start preparing for your Memorial Day, push. You might be going to vineyards out on the North Fork. You might be going to see your grandparents, your parents, going to barbecues. Again, these are things, but you're going to buy your gas at different points in time. But it'll start to see and show in the numbers. So according to Gas Buddy data, U.S. gasoline demand fell for a third straight week, down 1.7% Sunday to Saturday, which is the weakest weekly demand since the week ending March 20th. Demand fell week over week on Friday by 0.4% and Saturday by 5.3%. But now let's look at what's happening this week. So Monday gasoline demand was up 1.1% from the prior Monday, and then when we look at Tuesday, Sunday was up 2.3%. So again, was up 0.9%. So again, you're starting to see some of those moves. You're starting to get some of that benefit. So that's just telling me that we bottomed here. We'll start to see some of this back and forth, and then we'll start to move a little bit higher. But the biggest issue that we're going to continue to see, and so when you look at gasoline prices, you might as well just ignore the year ago. The year ago will be fine if you're talking about inflation and whatnot, or year-over-year inflation, but the better is week over week, month over month. And as we were saying last week, we expected to get to that $2.87. So we're just above it now. We went up by about a little over a penny. And again, this is where we're going to continue to see this grind up. And this is going to be the bigger impact to longer term just gasoline demand when we're thinking about, okay, well, this is clearly gearing us up to get to $3. And what does purchasing of gasoline look like at $3? And that's going to be, we typically start to see a tail off, and not aggressive. There's a certain amount of inelasticity within those numbers, clearly, but that's going to become a bigger overhang. And then when we look at diesel, diesel was flat week over week at $3.12. We still think that we're going to trend closer to $3.15, especially given the trucking demand that we continue to see. But you're just seeing, what that gasoline rate of change is going to be stronger versus diesel, especially because we are coming into the driving season. So you're going to have just more demand. We typically get an increase in pricing because of the way it's created and because there's more demand. So again, These are things that are expected. It's just we're in a very different period when you think about the rest of the U.S. from jobs, wages, savings, and this is going to eat into some of those movements a bit more than I think what the market expects. Now, blending components continue to grind higher. We continue to see blending components moving up. So I changed this chart a little bit. I wanted to look at when we essentially started adjusting the CAFE standards, when we really had more blending needs in general. So here you can see that we're still well off the, essentially the 9-year average or so. I should say 10-year average. But that spike, obviously, from COVID. But when you look at gasoline consumption and gasoline movements, we always talk about that blending component. So even though gasoline built 90,000 barrels in storage, we had blending components that were down 1.63 million barrels. So it's again moving that through the system, because that is where they're going to try to make that creation. Now, even though gasoline on the 5-year average, gasoline storage is 6.3 million below the 5-year. Blending components is only 4.7 below. So again, this is where the focus remains on creating that blending component, and you can see they're already starting to move that through the system, because you're going to have to blend differently at the rack to make sure that you can make that summer grade that will be consumed this year. So this is something where, again, we think that this is going to remain fairly flattish as we go through the next few weeks. And as we said last week, looking at the 15-year or so average, we came right back to it. This is where we want to get more specific, because year over year, since essentially we started looking at data, miles driven has gone up. So you're inherently going to outpace what we did in 2006, 7, 8. So we want to look at, okay, well, what is happening within the last 5 years? So here you can see, as we were saying, we were going to get a pullback. We expected to make a higher low, and that's where we got right to that high that we had. And here's where we think that we're just going to now go create like let's call it a chevron pattern to the right. And when you look at just essentially every year, specifically 18 and 19, we had a big spike. And now clearly I took 2020 out. So we had a big spike, going into next week. And that was because you had that demand getting pushed into and priming the system for the summer driving, which you can see in 17, you had that big increase. And then in 16, you had the same thing. It just happened a little bit later. So we will get a move higher in demand. The question is going to be, how does it fit over? And that's why we think it's going to be more of a sideways move. Next week or this week into next week, we think that we'll have a move up. We're not going to take out that high. It'll most likely be a little bit below that high as we go back and forth, but the trend will be up as we head into the driving period. Now, propane, we continue to see some small builds, a small build of 480,000 barrels, still 8.6 million below the 5-year average, but you can see we're starting to turn up. We're just at a very low point. This will start to accelerate. We'll start to close some of that gap as we go through the remaining few weeks. The problem is, or the benefit, I should say, we still see a lot of demand because we've had a lot of petchems that have converted from naphtha to LPG, which is going to keep our exports flowing, which will keep storage fairly low. So then when we look at the U.S., just looking at activity, the exciting thing is when we look at that 16 into 23, April 16th into the 23rd, we had a nice drop in COVID cases. That's going to continue to be the case, which as we have that steady move, we will see a little bit of a pause, just because, as you get that reopening, you're going to get some people that are going to get tested a bit more, maybe asymptomatic, but the trend is going to continue, especially when you think about the amount of vaccines we're doing. So that lockdown index will continue to move closer towards 50 as we have essentially schools reopening and many remaining issues with restaurants, bars. So we're going to have bars bar stools starting to come back. We're going to have bars reopening in a bit more detail. Restaurants will still be limited, but again, it's beautiful out, so we can get outside. All of that will be a net positive when we're thinking about some of that mobility. But then on the other side, which is something that we continue to talk about, is the work from home. Now, the thing that we continue to see is, then this is just looking at different surveys. You can see the economics, clearly the survey of just 2,100 workers. So it's not a huge number. So there could be a lot of skew in that. But this is what we continue to see. The numbers are very close to what has been the normal model, which is just where do people want to remain. So, 65% want to stay remote workers, 33% the hybrid model. And that's where I think that we're going to see that shift into the hybrid model versus the remote only. And that's going to be the one to watch, because those who commute know that commuting sucks. So the no commute is a huge component, and obviously that leads to more cost savings. So those two things are obviously the highest, which is why I think you're going to see that hybrid model take effect, because you'll try to do as much as you can when you're in the office, do those meetings, and then at home, maybe the less distractions, have some of that time to walk your dog in the middle of the day. But again, those are some of those things that I think we're going to become some of those headwinds. And then when we look at mobility, you can see where is that airfare going. And I thought this was an interesting one, because you can see just the average fare in 2021 versus 2019 continuing to remain depressed, even as jet fuel prices have gone up. But that starts to essentially go away as we get into September. So that'll be interesting to see. Do we add back flights? Do we just, or are you going to see some of this airfare as airlines try to just make more profit at this point in time and increase the load factor to make more money at this back end? Again, these are going to be things to see, but clearly fares in May are more than $50 lower than what they were in 2019, trying to incentivize to get people back into flights. But then when we think about mass transit, mass transit remains essentially nobody or very few people want that close interaction, which is going to push more people onto the road. And that will, again, drive people to say, okay, well, winter peak driving periods, maybe I'll just not go to the office that day. Maybe I'll take, I've gotten my vaccine, I'll take mass transit 1 or 2 days a week. Again, these are things that are going to impact some of that gasoline demand. And when we think about, just what has happened so far as travel, things remain fairly flat. And as we continue to say, as we head into to Memorial Day, we just don't see much change. Obviously, parks will continue to go higher as they did last year, but everything else we think is just going to go flatline at this point, with a bit more happening on the restaurant side, but we'll talk about that in a minute. Mobility, pretty much no change in the U.S., which is something that we've been talking about, where the U.K. saw a little bit of love, where the biggest change really came from Italy. But when you look at just kind of those economics in general, you can see that we're still fairly flat, which is why we continue to talk about gasoline the way we do, because we don't see that changing in the near term. Now, when we look at the vaccines, the U.S. has started to slow a bit. We'll talk about this a bit more in the Econ show, but those who want a vaccine or those who still want a vaccine can easily get one. Those that don't still don't. So you're going to start to see a slowdown in the vaccination rate. And it's not because we're doing anything wrong. It's just this is going to be now a consumer decision, and some consumers are saying, I don't want it. And so that's why we're going to start to see the U.S. Move lower. Where unfortunately, when we look at Germany, France, some of them have moved up, some of them have moved down, but we still see that very slow adoption. We've seen some of acceleration, but again, we're just not getting the pace that we really need, or at least the consumer needs to get comfortable. Now, when we look at jet fuel had a small build of 500,000 barrels. Here you can see, again, just sideways. We didn't expect anything outside of a purely sideways move. You'll start to see a little bit of an increase as we go through the next few weeks as airlines and airports prepare for, again, summer months equals more flying. That is a seasonal thing. That is nothing more. It'll just be at that reduced rate. And when we talk about the reduced rate, we always like to look at, okay, well, what are the flight departures? And you can see that they've done nothing with May jet fuel demand down as Europe cuts more flights from May. So we're seeing Europe cut some flights. But for the most part, we're fairly flat. In general, we had the average number of departures per day increased about 90 week on week. Thailand, India, Turkey led the declines, with the U.S. having some growth. That was already expected. So again, that's why it's just we're seeing Asia Pacific roll over. We're seeing Europe continue slightly to the downside. Realistically, Asia Pacific we think is going to continue to see a bit of a roll. And when we talk about the U.S., as we made the call back in essentially this, we made the comment mid-March that we were going to see an increase because of spring break, because of Easter, and then we were going to flatline, and here we are. And then when you look at the yellow bar, you can see that there's a natural increase as we go into essentially peaking July 4th. So that's what we continue to see. We're going to see an increase. That not saying we won't. We will see an increase. It's just going to be along seasonal lines at a much reduced rate. But in the meantime, we're going to average that 1.3 million passengers a day once you take the highs and lows, because again, that's just, we still have people that either can't afford it, don't want to, or if they want to, they've already done it, or they've already, the pent-up demand was there, people went to Orlando, whatever. Now you're going to start to see some of this this stabilization, this plateau at this level. Open table remains firmly kind of where we think it's going to be, within that 35% below normal on the weekdays, about 20% on the weekends. The U.S. is going to continue to get better. We should see this increase, which will pull some of that global number higher. Canada, Germany, Ireland will remain fairly tight. UK will start to see a little bit of an increase, but again, we're seeing some of that push and that pushback as we get to these levels. Some people still say, look, if I can avoid it a little bit longer, I will. Or, I'm going to wait for my vaccine, or I just don't feel comfortable in general, or maybe you don't have the money for it. So again, these are things that will keep us from getting right back to normal. But this increase in general, specifically in the U.S., will be a positive for jobs data, because we are getting a lot of hiring, and that's something that we're going to talk about in the Econ Show in more detail. Now, in the next section, we're going to go abroad, look at how the U.S. exports are being impacted and what's happening specifically, again, in India and Asia, and the physical market as a whole.